So, the Federal Reserve just did something pretty unprecedented. They cut interest rates for the third time this year, but this time they did it completely blind. For the first time ever, the Fed made a huge policy decision without a key piece of economic data they always rely on. And that changes everything.
So, what does this blind move actually mean for the markets and for you? Is this the kickoff to a massive rally, or is it a warning that something is about to break? The US Central Bank is on a path with two very, very different destinations, and it's that uncertainty that we really need to unpack.
So, what makes this particular rate cut so different? Well, the Fed was missing its roadmap. You see, the October jobs report, which is a critical indicator of economic health, was canceled because of the government shutdown. That means this decision was made in a total information vacuum. They were essentially flying blind into an incredibly complex economic environment.
But here's the thing, the Fed's move isn't happening in a bubble. There's a massive global force at play that almost no one is talking about, and it's coming all the way from Japan. It's called the Japanese carry trade, and it's been quietly shaping our markets for years, and now it's starting to unravel.
Now, the strategy itself is surprisingly simple. For decades, Japan's interest rates have been hovering right around zero. This let investors borrow Japanese yen for almost nothing and then turn around and use that money to buy things like US government bonds that were paying a much higher interest. It was a massive and very profitable financial loophole.
And the profit was just staggering. I mean, imagine borrowing money at 0.5% and immediately investing it in something as safe as US Treasuries paying 5.5%. You'd pocket a 5% difference for doing practically nothing. It was the ultimate free money machine, and for years, it worked flawlessly.
Until now. To try and boost its own economy after decades of stagnation, Japan has finally started to raise its interest rates. And suddenly, that free money isn't so free anymore. Traders have to pay back those loans at a higher cost. So, where do they get the cash? Well, they have to sell their US assets, stocks, dollars, even crypto, and pull that money out of our markets. Okay, so with this global pressure building, let's look back at the Fed's own playbook. Could their blind rate cut be a preemptive strike against this pressure coming from Japan? Historically, the Fed doesn't cut rates just for fun. They do it when they see trouble on the horizon, as a way to try and soften the blow of an incoming downturn. And the pattern is remarkably consistent. 2001, rate cuts as the dot-com bubble burst. 2009, rate cuts during the Great Financial Crisis. 2020, rate cuts just before the global shutdown. This is a really key point. The market didn't drop because of the rate cuts. The rate cuts were a response to the crises that were already unfolding.
And there's another major piece to this puzzle. On top of cutting rates, the Fed also just ended quantitative tightening, or QT. Now, think of QT as the Fed acting like a giant vacuum, sucking money out of the economy by selling off its assets. By turning off that vacuum, they are no longer pulling money out of the market, and that leaves the door wide open for more stimulus or money printing down the road.
Okay, so we've got a blind Fed, an unwinding carry trade from Japan, and the end of QT. What does this all mean for your actual investments? Let's break down the potential impact on stocks, crypto, and of course, the housing market. First up, stocks. With all this turbulence and the S&P 500 constantly flirting with all-time highs, it just feels like something has to give, right? But a drop might not be as catastrophic as you'd think. In fact, market drops are surprisingly normal. Research shows that a 10% correction happens, on average, about every 16 months. And when they do happen, the average decline is about 15.6%, lasting for roughly 71 days. So while these drops can feel really unsettling, they are a regular, and maybe even a healthy part of the market cycle. All right, let's pivot over to the world of crypto. Bitcoin has had a rough year, no doubt about it. And for the first time, it's actually positioned for an annual loss while gold is positive. It might seem like the magic is gone, but history tells a slightly different story. What we're seeing with Bitcoin today is, believe it or not, completely normal for the asset. In its 15-year history, Bitcoin has had 6 different periods where it crashed 50 to 80% from its peak. More recently, the typical decline has been closer to 40%. So as dramatic as the current market feels, this kind of volatility is just baked into Bitcoin's DNA. And that brings us to our final asset, housing. Now, this is a market that feels completely split down the middle, with a lot of conflicting signals for both buyers and sellers. On the surface, this number is staggering. Sellers are cutting prices by an average of $25,000, which is the largest discount Zillow has ever recorded.
But that's a little misleading because it often reflects sellers who overprice their homes to begin with. A more realistic gauge of the market is the median sales price, which is down a more modest 7% from its peak. So how do you navigate all of this? I mean, with a nervous Fed, global economic shifts, and volatile prices all over the place, the clearest path forward is to just stick to the fundamentals. And the fundamentals are what we know works over the long term. Having an emergency fund for unexpected events, maintaining a steady source of income, continuing to invest consistently regardless of the market noise, and most importantly, not letting these short-term price swings scare you away from your long-term plan.
Ultimately, this recent rate cut wasn't just another headline. It was the moment the Fed stepped into uncharted territory, acting without data, ending QT, and getting ready to inject money into an economy it can't fully measure. As the source puts it, this could be the environment for the greatest wealth transfer we've ever seen, or the moment people get completely wiped out. The stakes have never been higher.